With us this week is Shawn Bercuson, founder CEO of Early Asset Capital. Shawn, welcome to the program. A lot of attention on secondaries, but maybe a lot of concentration of attention on the top companies. SpaceX, which just went public, OpenAI and Anthropic, maybe a few others like Anduril. What's your take on kind of where the secondary market is headed, and what's your secret sauce for what you guys are focused on?
Yeah, so Early Asset Capital, generally speaking, we are a secondary fund, and we have technology called at earlyasset.com. The idea of early asset and our technology is to reduce the friction in the secondary market. We think right now there's a tremendous amount of friction, which is kind of stunting its growth. We think by removing that friction, it will open the aperture for the breadth and depth of the market. So what companies will be able to participate in secondaries going forward, in addition to how many people and which shareholders can also participate in those companies.
Well, before we dive into early asset, maybe you can give us a little bit of a thumbnail on how you got here and where you spent time in your early career, whether that's on the tech operator side, on the investment side, and what experiences gave you sort of motivation to get into the asset class that you're working on.
Grew up in Florida, of all places, and ended up going to landing in Chicago via Vanderbilt University. So went to school at Vanderbilt. After school, graduated with an economics degree. Went to Chicago to be a bond trader at the Chicago Board of Trade. So got my feet wet in the capital markets. Ended up joining a hedge fund private equity shop where I started my first company. It's kind of cliche, but started my first company on a train. On
a train.
I was working in Lake Forest, Illinois, which is about an hour north of the city, but I was young as 24, didn't want to move out of the city of Chicago. And so I had about an hour commute each way. And so just got bored. I didn't know I was an entrepreneur, didn't even know what that meant, but solved a problem and wanted to solve it. It was in peer-to-peer lending. So early days of peer-to-peer lending in the mid-2000s. Would go into work, read TechCrunch every day. That was like my source of information. Ended up finding some engineers in India to help me execute on this vision, and started to raise capital. So went to a few angels. Back then. Raising VC wasn't even close to what it is today. There was maybe one or two VC groups in Chicago, a couple of angel networks, and really nothing else in the Midwest. And so ended up finding an angel who was interested in my idea, and he introduced me to somebody else who was kind of the quote unquote tech guy of Chicago. So I went to pitch him the idea, and he said, "Hey, look, I like this idea, but I think I like you more than I like the idea. I'm going to buy it and you come work for me." And so this was pre-YC. I was a business incubator at the time, what we would call today a venture studio. Their whole thesis was apply technology to fragmented industries. And my job was to help come up with business ideas and write business plans around them and take them to market, which was at 26 a dream job. If you remember back in 2007, 2008, the economy crashed.
Yeah.
So it was not a great environment to start new businesses. So they said, "What are you going to do now?" And I ended up joining a portfolio company of ours called thepoint.com, based off the Malcolm Gladwell book, The Tipping Point. And so at the time,
this was part of the Groupon Mafia, right?
Oh, well, it was pre-Groupon. So the point
Pre-Groupon,
So the point is what Groupon became, or excuse me, the point became Groupon. So the point was a social network that binded like-minded individuals around a common cause. And so we would, we were trying to teach people how to use it, and we applied it to group purchasing. We called it Groupon, and I guess the rest is history.
Wait a second. You're skipping over a lot of exciting times and years there. Groupon was not just another startup. That was like the startup for many years. And, was really viewed as almost taking over the entire internet at one point. But wasn't that the case?
It was absolutely wild. We at one point, I think Forbes called us the fastest growing company of all time. We hit $1 billion in revenue in less than 2 years. None of us had any idea it was going to do what it did. And it was, everybody, all hands on deck, just holding on for dear life. And it was an incredible experience.
So it turns out there were some pretty smart entrepreneurs in Chicago.
Yeah, there still are. There's some interesting things happening there. I go back often, and it's really neat to see it continue to grow and mature.
So what kind of came out of your experiences there that sort of led you to secondary investing?
I had this problem. So I guess it's important to set the stage. back then secondaries were very taboo. To some degree,
Right.
it's less so now, but up until maybe 5 years ago, that was probably still the case. One of the reasons it was taboo was in 2012, under the Obama administration, the Jobs Act passed, and what that did was it increased the number of shares private companies could have from 500 to 2,000. So it's not the reason companies stay private longer, but structurally, it's a reason why they can. So back then, people didn't sell for it, that being one of the reasons, and number two is just culturally, it just wasn't that acceptable. But I had this problem, so I was leaving. No offense to Chicago, but at the time, I felt like I was playing in the minor leagues in Chicago. Also, didn't love the winters. I'm from Florida originally.
Yeah.
Uh, so
Right.
I so I wanted to move to San Francisco, and if I did that, I had options. And if you leave private companies, you have these options expire within a certain amount of time. But if you
Right.
exercise your
Have like
options, then you
90
have to pay,
days, 90
yeah,
days or so, right?
anywhere from 30 to 90 days. Some companies are starting to extend that
Okay.
window. But generally, I guess the assumption today is about 90 days. So I needed to figure out if I exercise these options, I had a tax consequence. In the eyes of the IRS, it's viewed as realized gain. And I was cash poor, had some options that were worth something, and I didn't want to walk from them. So there was a company at the time called secondmarket.com. They were really the first
Yeah.
secondary market
Barry
broker.
Silbert.
So I talked to them. I had nowhere else to go. But I discovered they were kind of a broker, and they wanted to take 5% from me as a seller, 5% from the buyer. And I was all
Yep.
about efficiency, and I'm value driven, as you can tell by my Groupon days. And so I was like, there's got to be a better way. And so I ended up finding a family office out of Georgia to help me, or to buy the equivalent number of shares I needed to sell to pay my taxes. So when I moved to San Francisco, Facebook and Twitter were still private. And that,
Yeah.
that excitement had bled over to Groupon and another company, Zynga. So those were the four companies that there was some demand for. So beyond that, people had heard I had sold. And so everyone was kind of interested of like, what is this thing? And so started kind of advising sellers on, who to talk to, things to look for, buyers who were interested in the space, and then companies who were interested or hearing about the secondary market, but needed to figure it out. And like, what is the process? Are we allowed to do this? Long story short, I ended up getting introduced to this one woman who was at a healthcare company. At the time, they had 13 clinics. She had a life event. She needed liquidity, and I was interested in buying the shares. So I went from being a seller to becoming a buyer, and that company turned out to be One Medical, if you're familiar with One Medical. So we ended up doing 30 transactions for One Medical before they went public via SPVs. And then once they went public in 2020, our investors were like, "That was cool. Go do that again." And so
Yeah,
I ended up
exactly.
I ended up starting a secondary fund called Bull VC with a few friends of mine.
Tell us a little bit about Bull VC and where did you start with your thesis on investing? I guess this was in Utah, right? Park City?
Yeah, so I had moved to Park City. My partners I had one partner at the time in San Francisco. He had moved to Boston, and another one in Nashville. And so these are the guys I had worked with on the One Medical stuff. And the thesis was, this was right around COVID. And so companies were all of a sudden staying private longer. The IPO market was open in 20 and 21, but all of a sudden shut pretty abruptly. And so what we were seeing with companies like Airbnb and those types of companies is they needed to figure out, because as companies hit that 10-year cycle, it's usually actually about 12 years. Their employees who have been there for the longest, since the beginning and been there for 10 years, those options expire even if you're still at the company. So there was
Right.
companies like Airbnb that were trying to figure out, now that the IPO window was closed for them, they were trying to figure out ways to satisfy the issue that they were facing with these employees who had been there a long time with expiring options. And this is becoming a structural thing that a lot of companies now have to think about. Now, previously, they didn't have to
Right.
think about that because exits were happening after 7 to 9 years. But today, fast forward, a lot of endowments and foundations are underwriting venture for 18 to 20 years. And so,
I was gonna say, yeah, we tend to think about VC funds being 15 plus year vehicles. I know they're structured as 10 plus 2, but the funds that I started at 500 are still, now 14 and 16 years old. So the first two funds with some significant assets in there. Canva being one of them, and a few others in other places. Intercom, which just got acquired.
Going back to Bull VC, our thesis was, hey, there's a lot of distressed shares in good companies. And, what does that
Right.
look like? And can we help these people out that had the problem that I had and also add value to the company at the same time? And so that's what we set out to do. Now, there was a lot of demand for the top 10 assets. And so our thesis was there's a lot of, really good companies, but there's no liquid market for it. So if we could focus on
Right.
those companies, we would have an edge. As a seller or as a current shareholder looking for liquidity, there's a few different things you need to pay attention to. The interest rates, a lot of times are floating or floating interest rates. So if you think that the company is going to have an exit within the next couple of years, that's a great option. If that exit turns out to be a lot longer than you anticipated, it can get more onerous than what you expected going in. And so,
Right.
as long as you go in with your eyes open and understand what the mechanism is and how it works, it could be a wonderful tool. But it's not necessarily one size fits all kind of thing. One of the structural things that attracts me to this market is, you look back 20 years ago, there used to be 8,000 public companies. Or
Yeah.
and maybe a little bit more than 20 years ago. Today, there's less than half of that, right? There's less than 4,000.
Right.
And so there's this whole segment
Although
of
the market cap of that is, now probably 3-5 times what it used to be. So,
Or more.
Half the number of companies, but probably 5 to 10 times the market value.
Yeah, and to your point about companies needing a certain amount of value to go public, the amount of revenue back then, if you on an adjusted basis to get public, was $62 million in
Yeah.
annual revenue.
When you say back
It's-
then, do you know what the revenue was for Amazon when they went public? I looked this up a little while ago for a research project. This is 1990. This is like 97 now.
I would say less than $50 million.
Yeah, they were like 17 million.
Wow.
And they were priced at 30 times revenue, and like people thought, oh, that's too expensive.
That's crazy.
Like
That's crazy.
$700 million for this, for this little company. That can't be. But I remember
It was a bargain.
Dave and I were at PayPal, and this is 2002, so this is after the dot-com crash and post SOX, and so we were getting into a more difficult time. We were just over 100 million when we IPO'd, and the IPO was it was $800 million IPO, right? So it was significant.
Right.
It felt big, but it wasn't like the decacorn IPOs of today. But it shows you how quickly, or at least how much the scale has changed in those 20 years.